Most S Corp owners are making a mistake that's quietly costing them thousands, sometimes tens of thousands every single year. And it's not because they're breaking the law or missing paperwork. It's because they're following the wrong advice about how to pay themselves. And if you're taking most or all of your S Corp profit as W-2 salary, you could be losing a fortune in unnecessary payroll taxes while your CPA tells you you're playing it safe. Let's challenge that idea right now. Most business owners think if I take everything as salary, I won't get audited, but the reality is you're not playing it safe, you're playing it expensive. The IRS doesn't want you taking all your profits as salary. They want you to pay yourself a reasonable wage for the work you actually do, and then you take the rest as distributions. That's literally the purpose of the S Corp structure. Here's why this matters so much. S Corp were designed to reduce payroll taxes and avoid double taxation, but only if you use them strategically. The rule is simple. Pay yourself a reasonable salary based on your role, industry, and responsibilities. Then take the remaining profit as distributions, which are not subject to Social Security and Medicare taxes. That's where the real savings are hiding. Most business owners feel like they're always losing the tax game. You work hard, grow your company, hire employees, and every year it feels like the government takes more. But here's the truth. The tax code is a roadmap, not a punishment. The IRS isn't your enemy, but it will happily take whatever you don't optimize, and the wealthy don't have different rules. They just use them differently. So why do so many owners miss this? Because most CPAs are stuck in compliance mode, not strategy mode. They play everything conservative, avoid difficult conversations, and you end up overpaying by thousands every single year. But the government actually wants business owners to succeed, invest, hire, and grow, which is exactly why these incentives exist in the first place. Let's simplify how this is supposed to work. Step 1, determine your reasonable salary using actual market data, your responsibilities, and your geographic area. Step 2, take the remaining profit as distributions, avoiding unnecessary payroll taxes. Step 3, review the structure every year with a proactive advisor who's focused on strategy, not just filing forms. Here's a real-world example. One client, a dentist in New York, had $1.3 million in net profit, and his old accountant told him to take all of it as salary. That triggered over $69,000 in payroll taxes alone, and because there was no remaining S Corp profit, he also lost the PTE deduction and the QBI deduction. That's not safe, that's financially painful. So what should have happened? We ran a reasonable compensation analysis and determined that $360,000 was appropriate for his role. The remaining $900,000 plus became distributions, saving him over $27,000 in Medicare taxes alone. And because profit remained in the business, he unlocked another $33,000 in PTE savings. That one change completely transformed his tax picture. This is where most people get confused. They think, my CPA said distributions are risky, but the IRS expects distributions in an S Corp. What they care about is whether your salary is reasonable. If you can document your number and justify it properly, you're not gaming the system, you're using the system correctly. Take Jessica, for example. She had a $300,000 profit and was paying herself a $200,000 salary because her CPA said it was safer. After reviewing her industry and role, we adjusted her salary to $100,000. And that shift alone saved her over $15,000 every single year in payroll taxes. Same income, same business, completely different strategy. Or David, a consultant who is missing out on the QBI deduction because his salary was too high. By restructuring his compensation correctly, he reduced payroll taxes and unlocked a 20% deduction on his business income, saving another $10,000. Or Maria, who had never even heard of the PTE deduction until we optimized her structure and saved her over $25,000 in state and federal taxes. The mindset shift is simple. Stop thinking like an employee and start thinking like an owner. Employees take salary and pay the highest taxes. Owners use structures like S Corps to pay themselves strategically and keep more of what they earn. Now, there is a right and wrong way to do this. If your salary is too low, that's a red flag. If it's too high, you're overpaying taxes unnecessarily. If you don't document your compensation analysis, you're exposed. And if you never review your structure, you're leaving opportunities on the table every single year. So what should you actually do? Gather industry salary data. Then document your responsibilities by brainstorming what your week looks like and the various tasks you perform. Then, based on those responsibilities, benchmark your compensation, set a salary within a reasonable range, and then shift the remaining profits into distributions. Review everything annually because your business changes, your income changes, and your strategy should evolve too. And once you understand this, you can stack strategies, optimize a salary, then layer in QBI deductions, PTE deductions, retirement plans, cost segregation, and advanced entity structures. That's how business owners go from saving a few $1,000s to saving 5 and 6 figures legally. Look, you don't build wealth by simply making more money. You build it by keeping more of it. Every dollar you keep becomes fuel for growth, investing, and freedom. And the S Corp structure is one of the most powerful tools available for business owners, but only if you actually use it strategically. If you want to see how to turn the money you're already spending on your home, your car, your meals, and your travel into legal tax write-offs that shrink your IRS bill even further, watch the next video, How to Make the IRS Pay for Your Everyday Expenses. I'll show you how to stack these strategies together and turn ordinary spending into extraordinary tax savings. Because at the end of the day, it's not what you make, it's what you keep. So start keeping more.